Incorporated today. Eskom of South Africa implements stage 6 load shedding again. Egypt discovers large gas field off its northeastern Mediterranean coastline. And Zimbabwe announces new fuel prices. Good afternoon. Thank you so much for joining us on this afternoon on Business Incorporated here on Channels Television. I'm Ini John Mekwa. Let's kick off with intraday numbers on the African continent, starting with NGX. It has maintained that positive sentiment at intraday at 0.05% and growing on that 49,000 this afternoon, 49,255.90. In South Africa, it's still negative, continuing from what happened yesterday at 1.76%, almost 2% in the red at 72,989.38. We look at other aspects or other regions on Africa. Now it's positive for Egypt. Closed today for Thursday, it closed positive 0.54. And Kenya also, this is for Thursday, 0.11 in the red at 128.09. We move over now to the Middle East, where it's positive sentiment in major markets. In the UAE, the UAE opens today while the other markets are closed. That's Saudi Arabia and Qatar closed on Fridays. And so we see that Abu Dhabi is in the green more than 1%, 1.30% at 10,300.84, while Dubai is 0.15% in the positive territory, 3,320.17. As we said, the other markets, that's Qatar and Saudi, they closed. Qatar closed positive for the first time in a couple of days now, and Saudi closed negative yesterday. Both of them do not trade on Friday. Well, moving on now, let's go to Europe. And Germany is one step closer to achieving energy independence from Russia after the arrival of a huge ship that will act as a floating liquid natural gas terminal in the port, in one of their ports on the North Sea. We have given us the details now. Kate Ferguson joins us from Berlin. Hi, Kate. Good afternoon. Back here, we say thank God it's Friday. But tell us more about this project. I'm sure Germans are happy about this.
So this project is a really big part of the German government's plans to become less dependent on Russian gas. And construction has taken place at an incredibly rapid pace without the usual bureaucracy and the environmental scrutiny that you would expect from projects of this kind. The arrival of the ship is a milestone because it is the first vessel that's been allowed to import liquefied natural gas into Germany. The site is actually operated by German energy company Uniper. It had originally planned to build a green hydrogen hub here, but it was then persuaded to receive LNG instead. And just to give you an idea of scale, the vessel that has just arrived is 300 meters long, and it's carrying enough LNG to supply German households for an entire year. Now, the German government has invested billions of euros in this project, and this weekend the terminal will be officially opened with German Chancellor Olaf Scholz, the Economy Minister Robert Habeck, and Finance Minister Christian Lindner all in attendance. That is a sign of the huge importance that Germany is placing on this project.
Yeah, so I guess we cannot divorce this from what's going on in Ukraine and the attempt to win off Russia gas.
So traditionally, Germany has been a huge importer, one of the world's biggest, in fact, of regular natural gas. And last year, just to give you an example, natural gas made up a quarter of its energy demand. So for years, the country wasn't really very interested in liquefied natural gas because it got enough gas through pipelines, notably the Nord Stream 1 pipeline from Russia. Another reason they weren't so into LNG is that it's more expensive than gas that arrives through a pipeline. Everything changed, though, when Vladimir Putin invaded Ukraine. Suddenly, Germany had to find alternative supplies. And they then realized that liquefied natural gas actually does have some advantages over its alternative. For one thing, you can store around 600 times more gas when it's in liquid form. And of course, it can also be transported via ship or truck or rail instead of just pipelines. So Germany went all in on investing in LNG infrastructure. Wilhelmshaven is the first of several LNG terminals that have been planned. And the government says they could eventually be converted to handle more climate-friendly gases. And this is really important because Germany has committed to replacing fossil fuels as part of its green energy transition.
Yeah, so let's do a little bit of recap and look at the markets. What are some of the high points of the market this week?
So this week we saw a slew of interest rate hikes from the Federal Reserve in the US, the European Central Bank, and the Bank of England, to name a few. And investors had been pricing in these rises. They're relatively predictable. But what they were really looking out for was an indication of what we can expect in the months ahead. And it seems that there'll be further rate rises ahead. European Central Bank President Christine Lagarde indicating that a further 3 hikes could be on the cards. That worries investors because the Eurozone is already on the brink of a recession, and they fear that even higher rates could tip it over the edge. It is, though, a really tough balancing act, taming inflation while not destroying growth. And for emerging economies, it's, of course, a major source of concern. Their currencies respond very much to interest rate decisions in advanced economies like the United States. And because much of their debt is held in dollars, there's a very real fear of being able to meet repayments. The other issue is that a lot of emerging economies receive their imports in dollars, and that means that they've become, the prices of raw materials, for example, has become much more expensive, and that weakens their currencies. So the impact of the decisions we saw this week have a huge ripple effect, both on the markets and on people's everyday lives.
Yeah, sure. Everyday life, that's in focus now. Thank you so much, Kate. We'll do it again next week. All right, from Europe, we go to the UK, and we have Juliana joining us from our studio there. Hi, Juliana. Good afternoon. Yesterday was another interest rate being raised, and this time is the highest level in 14 years, beg your pardon. And well, we saw the GDP grow, and then we wanted to have a little bit of a sigh of relief, but it seems not yet time for that, I guess.
Good afternoon, Innie. Not yet time, no, unfortunately not. In an effort to kind of control inflation, which we know is at a 40-year high, 10.7%, the ONS revealed this week. The Bank of England yesterday, the Monetary Policy Committee, decided to hike interest rates for the 9th time in a row, although it was much lower than we saw in the previous gathering of 0.75%. They hiked it by 0.5%, meaning that interest rates are now at 3.5%. That is staggering, considering if we go back to this time last year, Innie, it was at 0.1%. What does that mean? It basically means it's more headache for mortgage owners because it just costs more to borrow. They had a significant change in their monthly output during Liz Truss's 6 weeks of struggle as Prime Minister. But now that the interest rates are going up, it is going to be incredibly hard for them. And Andrew Bailey said we are going to see more hikes in the months to come because, yes, inflation dipped slightly between October and November by, I think, about 0.4%. It is still so high. And if we look at CPI on its own, you don't see the full picture. But if you zoom out slightly, then we can see that food inflation is at 16.5%, which means next weekend it's going to cost families in this country who are already on the brink, millions of them, much more expensive to put a Christmas turkey on their table for their families. So that is a major, major issue. We also had retail sales figures out today showing that retail sales dipped 0.3% in the month of November. Now, this is quite alarming because, of course, we had Black Friday, didn't we, where that is typically a time millions of people spend billions to try and save money before Christmas. But that wasn't the case. We haven't had the official figures yet. But a 0.3% at a time where most things are on sale does show that we are likely to be in a recession, which is what was mentioned yesterday by Andrew Bailey, the Bank of England governor.
Yeah, and there we were hoping that the growth in GDP would indicate that we would escape that recession. But another not good news coming from the unions, the strikes. And RMT boss says no new offer on the table.
Yeah, that's the case. There's just misery for most people in this country. If you're living in the country, then you are most likely going to have been impacted by strikes. Not just the strikes that have happened this week, many of them unprecedented. Yesterday, we had over 100,000 members of the Royal College of Nursing downing tools for the first time in over 106 years. That is very significant. The British government, they say they are not going to negotiate with them. Stephen Barclay, the Health Secretary, says that they are listening to the Independent Pay Review Body, which is a separate actor working away from the government. They have suggested that 4 to 5% is basically what the coffers could afford. The Royal College of Nursing saying they want 19%, which is nearly 10% above inflation. That's not going to happen anytime soon, unfortunately, which means there will be another nurses' strike next week, Tuesday, unless there is a Christmas miracle. We know miracles can happen, Innie, and the government do sit down with the RCN to try and find a resolution to this. There's also strikes in rail and postal. So unfortunately, if you are watching from the UK and you haven't posted your Christmas card, it will not get to whoever the recipient would have been before Christmas. That's really significant. That's also having a knock-on impact on retail, because we know most people shop online, and if you don't get your goods ordered in time, you're not going to be getting them before Christmas. The RMT, that is a long-running dispute, again, over pay, jobs and conditions. There is some negotiation between Mick Lynch, who's been dubbed Mick Grinch by the press here in the UK. You know how harsh they can be, Innie, because they're not happy. So many Christmas parties, Christmas gatherings, family reunions have had to be cancelled because people just can't get across the country. And unfortunately, the headache doesn't stop there. We are also going to be anticipating strikes this weekend by border staff, airport workers. So for some people, you know, the flight to get to London is going to be much quicker than it will be if you reach the border and you can't get your passport stamped. So lots of headache. According to some economists, it's cost the British government £2 billion, these industrial actions so far, and there is more to come in the new year.
Yeah, and all of this is feeding into that threat of recession, you know, just stunting growth and driving the economy into the red. Just briefly, Juliana, how's the market at this time? I hope it doesn't have that much red.
It does. Red is the colour of the market. Red is the colour of the season, but certainly the blue chip index, which is down at intraday. I think it's got a lot to do with those ONS figures from retail sales showing that November, which should have been a prime month, was a contraction for them. Not good at this time of the year. The all shares down 1.13%. FTSE 100 down by even more at 1.37%. And even more than that, the domestic market, the FTSE 250, that's down by 1.77%. In the currencies market, however, the British pound continues its rally against the US dollar. It's up by 0.12%. Also up against the euro by 0.14%, but down against the Japanese yen at intraday by 0.45%, Innie.
All right, Juliana, thank you so much for that update. We do wish you the best. I mean, with all of the strike and the threats going on.
I need it. Thank you, Innie.
All right, let's move to another part of the world now. Asia-Pacific markets traded mostly lower as recession fears grow. Disappointing U.S. retail sales for November suggested inflation is taking a toll. Let's look at the numbers now. The Nikkei 225, everything in the red. I mean, just at a glance, we see it's a sea of red, just as Juliana talked about the markets in the United Kingdom. The Nikkei 225 almost 2% down. The Shanghai down slightly, 0.02%. The Hang Seng Index down almost 0.5%, 0.42%. Kospi 0.04%. And in Australia, AX 200 is down almost 1%. We move over to the United States now, and there we see features were lower also Friday morning as investors responded to data that elevated concerns of a looming recession and looked ahead to a slew of Federal Reserve speakers scheduled for later on today. The Dow Jones in the red. These are the features, more than 1% in the red. S&P 500 also in the red. The Nasdaq also in the red, 0.83%. It's a red market, red expectation for the US. Well, with these latest declines, the market is heading into Friday with all the indexes poised to notch a second consecutive week of losses. Stocks have been falling in the wake of the Federal Reserve's 50 basis point interest rate hike to a target range between 4.25% and 4.5%. That's the highest rate in 15 years. The central bank says it would continue to hike rates throughout 2023 up until it gets to 5.1%, which is a larger figure than previously expected. Let's take a breather now. When we come back from that break, we'll have more stories from you, especially looking at what are some of the benefits, advantages from the US-Africa summit that just concluded yesterday. What does Africa stand to gain, or what is the United States looking for? We'll discuss that with Matt Kindiga after the break. Just stay with us. This is Business Incorporated on Channels Television. Welcome back. Still watching Business Incorporated here on Channels Television. Well, the summit is ended. A high point, some of those pronouncements by the United States President Biden, about investment and assistance to be given to African continent. But questions have been coming up from that summit, the US-Africa summit, that what really is the interest of the United States in Africa? Well, we'll have Matt Kindiga now to share a fresh perspective to this. Hi, Matt. Good afternoon.
Hi, good afternoon. Thanks for having me on the show today.
Good to have you, Matt. So what can we say is really behind this Biden's administration push to deepen the US-Africa relations?
Yes, well, certainly, in our view, there are several factors that are behind the Biden administration's desire to strengthen relations with Africa. The first is effectively it's looking to try to counter the effects of rising influence of China and especially Russia across Africa over the last couple of years and decades. This has been aggravated by the neglect of US-Africa relations under the previous Trump administration, but this has become particularly concerning since the Russian invasion of Ukraine. It was quite well noted in the US that many African countries, including South Africa, declined to side with the US in condemning the Russian invasion of Ukraine at the UN earlier this year. So it realizes it has a lot of work to do to try to bring African countries back into its sphere of influence. Secondly, Africa offers huge opportunities for US businesses. It's a very large market, but it's also largely untapped by many many American companies, and they do see it as offering substantial opportunity. And in relation to this, as we are seeing tensions around globalizations, rising tensions between the US and China, the US is looking for alternative sources of raw materials, but also alternative markets to China, for example. So certainly there is a significant corporate interest. And thirdly, the US is quite concerned about rising security challenges in parts of Africa, including the Sahel, and it wants to make sure that it is playing as much a role as it can to try to stamp out these security challenges before they become more of a global problem.
Yeah, it's good you mentioned security there, Matt, because a lot of people are wondering how the U.S. is going to deal with the security threats in the Sahel, as you mentioned, given the controversial withdrawal from Afghanistan last year.
Yeah, so certainly the U.S. has had its fingers burnt after withdrawing from the U.S., and it is sort of recalibrating its approach to regions like Afghanistan and also the Sahel. The US is very aware that the Sahel is home to some of the fastest growing and largest and most dangerous sort of terrorist organizations and extremist organizations globally. And it's concerned that the Sahel may become a breeding ground or an incubator for the next global Islamist-inspired terrorist threat, especially those groups that are linked to Al-Qaeda. So effectively, the US wants to make sure that its mistakes in Afghanistan are not repeated. And this will likely involve it focusing on dealing with the root causes of the problems rather than reacting to them, and making sure that it has a long-term plan to prevent this from becoming a global problem. And this will take the form of the US government providing financial support as well as technical assistance to some of the most vulnerable countries that are relatively stable at the moment, so including Ghana, Cote d'Ivoire, a few others as well. in ensuring that governance standards are upheld, economic growth improves, rule of law is adhered to, democratic institutions are as strong as they can be as well. And we're also likely to see the US becoming a lot more forthcoming in providing direct and generous assistance to support vulnerable populations, for example, those that are vulnerable to climate change or the effects of conflict, so to prevent more extremist activity from developing. So we certainly would expect the US to take a more multi-pronged and more direct approach in trying to counter these extremist threats in especially regions like the Sahel.
All right, so we had a lot of pronouncements, especially from President Biden, especially for the one that came from the forum, the investment in billions of dollars and then the assistance. But the impact and the reality of it is actually what catches a lot of people's fancy.
Yes, that's right. So there's a lot can be said about the scale of the investments and the commitments made during the summit, but actually, what will this mean in practice? Overall, our view in the longer term, it's actually a very positive development, and it is a very welcome development that the US is taking engagement and investment and trade with the African continent much more seriously. But in the shorter term, in other words, the next 12 to 18 months, we're likely to see very limited effects, and this is because of what's happening with the global economy. So firstly, the positive effects are actually quite substantial. So in the long term, we're going to see things like several $1 billion committed towards improving exports from the US, from Africa to the US, so facilitating freer trade, investing in export infrastructure, for example. We also have had very large investments by individual companies. So, for example, Cisco, the big IT tech company, has announced $800 million in investing in cybersecurity in Africa, which is fantastic. And also, the US government has committed to providing $350 million in improving investments into renewable energy, which is also very positive. But the effects on African growth, as I've said, will be relatively limited in the short term. And this is because they will be outweighed by the fact that the US economy is slowing. We are seeing inflation rise to multi-decade highs. Interest rates are also rising very quickly, which is reducing appetite for investment, both in the US, but also by US companies overseas. And as also the US economy slows, we will see weaker demand for African exports, especially raw materials and commodities. So in the short term, we're probably going to see very limited direct effects, but actually over the longer term, it is quite a positive development for US Africa trade and exports from
Well, talk about long-term expectations there, Matt Kiniga. Thank you so much for joining us this afternoon.
Thanks very much.
All right, let's just move on now. Egypt has discovered a large gas field off its northeastern Mediterranean coastline. Oil minister says that the field's reserves were still being assessed, but the authoritative Middle East Economic Survey this month said that it has 3.5 trillion cubic feet of gas. And we move away and still talking about gas. Algeria's gas export hit a record high of 56 billion cubic meters in 2022. Authorities are seeking to rationalize the consumption of gas destined for electricity production in an attempt to take advantage of the high global gas prices. The president says that his country's national hydrocarbons company, Sonatrach, it has to double its gas production to reach 100 billion cubic meters of exports by next year. And Zimbabwe Energy Regulation Authority has announced a drop in fuel prices for petrol and diesel effective yesterday. The regulator says that blended petrol is now pegged at $1.50. It was formerly $1.55, while consumers will now pay $1.62 for diesel, and that's down from $1.66. Eskom shifted load shedding to stage 6 from early Friday morning. The struggling power utility attributed the highest stage to the overnight and morning failure of 8 generating units, which necessitated the excessive use of open cycle gas turbines and pumped storage generation. The inability to pump water overnight at the pumped storage schemes and the low diesel levels has resulted in critically low emergency reserves, which needs to be conserved. Eskom will publish a further update as soon as there's any significant changes. Well, that's it for the program this week. Thank you so much for being a part of it. I'm Minnie John Merko. Have a great weekend, and we'll meet again on Monday, God's grace.